Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. So I have explained you there are four categories of ratios. We have classified the ratios into four categories. That is, first one liquidity ratio, then second one solvency ratio, third activity ratio, and the last one is profitability ratios. So in the previous videos I have explained the meaning of these four terms, that is liquidity, solvency, activity and profitability. Last video I have explained the complete video regarding the liquidity ratio. The liquidity means ability of the business to pay the current obligations on time. So every business wants to find out what is the ability of payment of current liabilities on time. That is called liquidity. For finding out the liquidity, we have three ratios, liquidity ratios. That is, first one current ratio, second one liquid ratio or quick ratio or acid test ratio, third one absolute liquid ratio. All these things I have already explained in the previous video. Now in this video I am going to explain you the second category of ratios, that is solvency ratio or leverage ratio or structural ratios. So before explaining this, take the screenshot of the points which I have written on the board, and also if you have not watched the earlier videos, I suggest you go to the playlist of my channel, select the subject accounting for management, select the videos financial statement analysis, watch the earlier videos, be perfect regarding financial statement analysis, then ratios, ratio analysis, then what are the different categories of ratios. Take the screenshot, then I'll explain all the points in detail. Now, first of all, solvency ratio or leverage ratio or structural ratio, all these three terms means the same. What do you mean by solvency? The term solvency refers to the ability of the firm to pay the debts. Every business will have so many liabilities, debts. What is the ability of the business to meet the debts, to pay the debts? That is called solvency. The solvency are of two types, short-term solvency and long-term solvency. The short-term solvency is called liquidity. Already we have discussed in the last video, liquidity ratios. The solvency, another term solvency, is the long-term solvency. And that long-term solvency means whether the business has the ability to pay the long-term liabilities, the long-term debts, whether the business can be able to make the payment or not. For that purpose, we calculate solvency ratios. So solvency ratio facilitates ascertaining long-term solvency of the firm. By applying these ratios, we can be able to judge, we can be able to ascertain whether in the long run the business can be having the ability to pay the liabilities or not. Now the level and impact of leverage can be evaluated by using solvency ratio. Leverage means using of debt in the business. Nowadays, no business will depend only on owner's capital. Every business will keep some leverage. Leverage means using the debt in the total funds used in the organization. So in any organization nowadays we find two types of fund, owner's fund and debt fund. So this debt fund is nothing but the leverage. So what is the impact of leverage? The leverage will increase the earning per share. The profitability of the business will increase by using this leverage, by using the debt in the capital structure. So what is the level and impact of leverage can be known by using the solvency ratio. Hence these ratios are also called leverage ratios. We can call it as solvency ratios or we can call it as leverage ratios. Leverage ratio indicate the relative interest of owners and outsider in a business. So these ratios will explain what is the proportion of owner's capital and what is the proportion of debt funds. The relationship between owner and debt, that can be known by applying the solvency ratios. The significant leverage ratios are as follows. See here, there are innumerable ratios. There is no limit to ratios. But normally, what are the ratios which are used to evaluate the solvency of the business? I am giving you 6 ratios. These 6 ratios are commonly used to evaluate the solvency of the business. The first solvency ratio is debt equity ratio. That means in the total funds employed in the business, what is the proportion of debt and equity? How much is debt and how much is equity? For that, to find out the proportion of debt and equity in the business, we apply debt equity ratio. It reflects the relative claim of outsiders. Outsider means the loan providers or providers of debt, and the owners. The owners are the shareholders. Shareholders have invested the money, and also outsiders have invested the money. The outside money is the loan taken from bank or debentures issued, bonds issued. These are debt fund. So it reflects the proportion of owner's fund and debt fund against the assets of the firm. That means if the assets are 10 lakh, in the total assets of 10 lakh, how much proportion is financed by owner fund and how much is financed by outsider debt fund? Debt usually refers to long-term liability. Debt does not mean short-term current liabilities. Current liabilities are also debts, but we should not consider it as a debt. It will be treated as a current liability. So here debt means only long-term debts. And equity includes equity and preferential capital and reserves. When we come to debt and equity, equity does not means only equity share capital. Here equity means shareholders fund, and shareholders fund include equity share capital, preferential capital and reserves and surplus. So what is the formula of debt equity ratio? The formula for debt equity ratio is long-term debt divided by shareholders fund. So long-term debt consists of debentures and long-term loans. Debentures and long-term loans combined is called long-term debt. And shareholders funds consist of equity share capital plus preferential capital plus reserves and surplus minus fictitious assets. Fictitious means imaginary assets. Some items are there which show debit balance, but it is not a real asset. It will be called fictitious asset. So if there are any fictitious asset, deduct. So again I repeat, shareholders fund consists of equity share capital plus preferential capital plus reserves and surplus minus fictitious assets. A debt equity ratio of 2:1 is considered normal. We cannot give a fixed ideal ratio for every business. Just like a doctor cannot prescribe the same medicine for every disease. The doctor has to analyze, find out what type of disease the patient is having, suffering. Accordingly, he will treat. Similarly, we cannot give an ideal debt equity ratio that this should be the ratio for every organization. No. Normally we can say the ideal debt equity ratio is 2:1. That means the debt may be double the owner's fund. If the business is having owner's fund 10 lakh, then a maximum of 20 lakh debt is enough, not more than 20 lakh debt. So a firm with a debt equity of 2 or less exposes its creditors to relatively lesser risk. So whenever a creditor wants to invest in the business, they will see this debt equity ratio. If the debt equity ratio of 2 or less, then the creditors will come forward to invest the money. The creditor will say that there is less risk in the business, so they come forward. So if a business is having a debt equity ratio of more than 2, then creditors will move back. Creditors will not come forward to invest. They will say heavy risk is there in the business. They will not come forward. A high firm with high debt equity ratio exposes creditor greater risk. So a creditor will be at a greater risk if they lend the money to a business who is having more than 2 as debt equity ratio. First debt equity ratio I've completed. The second solvency ratio is proprietary ratio. The proprietary ratio, it expresses the relationship between the net worth and total assets. Net worth means shareholders' funds. Net worth means shareholders' fund. So what is the relationship between net worth and total assets? That will give you proprietary ratio. A high proprietary ratio is indicative of strong financial position of the business. If high proprietary ratio is there, that means the business is having more net worth, more shareholders fund. Normally the people will come forward and invest in the business, dealing with the business when they see that more owners fund is involved. If owner fund is less, then definitely the creditor outsider will hesitate to come and join the business. So a higher ratio, proprietary ratio is better. Now the higher the rate, the better it is. The proprietary ratio formula is net worth by total assets. The net worth means the shareholders fund, and shareholders funds means equity share capital plus preference share capital plus reserves and surplus minus fictitious asset if any. If it is there, then deduct fictitious assets. If it is not there, leave it. Only preference share capital, equity share capital, reserves and surplus. That is net worth or shareholders fund. And total assets means non-current assets plus current assets. Non-current assets means fixed assets plus current assets. That will give you total assets. So two solvency ratios are explained. One debt equity ratio, second proprietary ratio. The third one is capital gearing ratio. This ratio shows the relationship between funds bearing fixed interest and fixed dividend to equity shareholders fund. There are some funds which bear a fixed rate of interest and fixed rate of dividend. Example, debentures, bonds, these will carry fixed rate of interest. Preference share capital, this carry fixed rate of dividend. So we combine funds bearing fixed interest and funds bearing fixed dividend to equity shareholders fund. Equity shareholders funds consist of equity share capital plus reserves and surplus minus fictitious assets. So that is capital gearing ratio. The formula for capital gearing ratio, funds bearing fixed interest, fixed dividend. The funds are debentures plus term loans plus preference share capital. So these three things will take it in numerator, and denominator equity shareholders fund. So equity shareholders fund consists of equity share capital plus reserves and surplus minus fictitious. A company is said to be highly geared if it has a high capital gearing ratio. So if the capital gearing ratio is more, it means the company is highly geared. Highly geared means more risk is there with the company. If the capital gearing ratio is less, it is low geared. When the company is having a low geared, then creditors may come forward to invest the money because risk is less. Higher the capital gearing ratio, more is the risk. Lower the capital gearing ratio, lesser is the risk. So the extent of this gearing determines the financial structure of the business. So this capital gearing ratio will determine the financial structure of the business. That means how much is funds bearing fixed interest and fixed dividend and how much is equity. A company that is highly geared will have to raise funds by issuing fresh equity shares. Whenever the company wants new funds, the company will calculate capital gearing ratio and see. If the capital gearing ratio is more highly geared, then the company will go to issue equity shares. The company cannot take the risk of issuing debentures or preference. They will go for equity because it is highly geared. Suppose if the capital gearing ratio is low, that means the risk is low, the company can afford the risk, then the company can issue debentures or preferential capital. That's it. This is about capital gearing ratio. The next ratio is fixed assets ratio. That means the fixed assets are financed from which source of funds? Two sources of funds are there, short-term funds and long-term funds. It is a prudent policy to invest in fixed assets from the long-term funds. From the long-term funds, not from the short-term funds. The long-term funds consist of equity share capital, preference share capital, reserves and surplus, or long-term debts like debentures or loans, etc. So this ratio indicates the mode of financing the fixed assets, how the fixed assets are financed, from which source of funds fixed assets are purchased. So it is calculated as fixed assets ratio is equal to net fixed assets divided by capital employed. Now remember the formula for capital employed. Capital employed means shareholders fund plus long-term debt. Simply, shareholder debt plus long-term debts. Shareholders fund, equity share capital, preference share capital, reserves and surplus. These three constitute shareholders fund plus long-term liabilities. The long-term liabilities are debentures or term loans, etc. minus fictitious assets. If there is any fictitious. This is the meaning of capital employed. It will be taken in denominator. A financially well-managed company will have its fixed asset financed by long-term funds. Ultimately, the interpretation is the company should invest in fixed assets from long-term funds. No short-term funds should be used to finance the fixed assets. That is the rule. Now, therefore, fixed asset ratio should never be more than 1. When you calculate the fixed assets ratio, it should never exceed 1. That means the fixed asset should not be more than capital employed. The fixed asset always should be lesser than capital employed. And the ideal ratio is 0.67. That is considered as ideal. That's all. This is the capital gearing ratio. The next ratio is interest coverage ratio or debt service ratio. Interest coverage ratio means how many times our profit is of interest charges. So every investor in the business, every lender of money, supplier of funds will see this interest coverage ratio. They want to know how many times of interest they are earning the profit. Example, the fixed interest of 10,000. Every year 10,000 rupees fixed interest has to be paid. The profit of the company is 1 lakh. Profit of the company is 1 lakh. That means 1 lakh divided by 10,000, you will get 10. That means the profit is 10 times of interest charges. The profit of the business is 10 times of the interest charges. That is interest coverage ratio. So if the interest coverage ratio is more, then the supplier of funds will come forward and invest. If the interest coverage ratio is lower, that means the company is not earning sufficient profits. Then no supplier of fund will come forward to invest the money. So here, this ratio indicates whether a business is earning sufficient profit to pay the interest charges. So the lender of money wants to see whether the company is earning sufficient profit or not, so that the company can be able to pay the interest charges. So the formula for interest coverage ratio is PBIT, profit before interest and tax. The full form of PBIT, profit before interest and tax, divided by fixed interest charges. Now PBIT, how to calculate PBIT? PAT plus interest charges plus tax. If in the problem PAT is given, profit after tax is given, to PAT add back interest charges and add back the taxes, you will get PBIT. Then a debt service ratio of around 6 is normally considered as ideal. The ideal interest coverage ratio is normally considered as 6. That means the profit should be 6 times of interest. Suppose the interest charges are 60,000. The company must have a profit of 60,000 or more. Suppose the interest charges are 10,000, the interest charges are 10,000, then the profit should be 60,000 or more. Then only the company is considered as good, having good interest coverage ratio. A higher ratio, better it is. Next, last one is dividend coverage ratio. Dividend coverage ratio shows how many times the profit after tax is of fixed preference dividend. Example, the fixed preference dividend is 10,000 rupees. So 10,000 rupees fixed preference dividend. Whereas the profit after tax is 1 lakh. The company has earned profit after tax 1 lakh. Whereas fixed preference dividend is 10,000. So 1 lakh divided by 10,000, you will get 10 times. So dividend coverage ratio is 10 times. That means the profit is 10 times of preference dividend. That is dividend coverage ratio. It indicates the ability of the business to pay and maintain fixed preference dividend to preference shareholders. So normally, preference shareholders are interested in finding out dividend coverage ratio. They want to see how much the profit earns in times of preference dividend. So formula for dividend coverage ratio is PAT divided by fixed preference dividend. PAT stands for profit after tax. The higher ratio, the better it is perceived by investors and financial analysts. A higher dividend coverage ratio indicates that the business is having sufficient profit to pay the preference dividend. That's why it is important for prospective investors in preference shares and financial analysts. That's it. So in this video, I have explained you about the solvency ratio and what are the different types of solvency ratio. Remember, doing the problem, simply applying the formula and getting the answer, that is not the end of the matter. In the problem, it will be asked to give the interpretation. So until and unless you know the meaning of that ratio, you cannot give the interpretation. So my suggestion, if you want the perfect knowledge, in-depth knowledge, good command, confidence on this subject, on these concepts, watch the video till the end. Every video. Then only you can be able to have a good command. Otherwise, simply you will pass the examination by simply remembering all the formulas. That is not the end of the matter. So watch all the videos. Inshallah, in the next video, I'll take up the next category of ratio. That is activity or turnover ratio. So inshallah, we'll continue the next topic in the next video.